Today, we're diving into the fascinating world of international economics, exploring how nations interact on a global scale. This field helps us understand the intricate ways countries interact economically, influencing trade, finance, and global policies. We'll begin by exploring two fundamental concepts: absolute and comparative advantage, crucial for understanding trade. These concepts form the very foundations of international trade, explaining why countries specialize and exchange goods. First, let's define absolute advantage, a key concept that helps us understand basic trade benefits. It means a country produces a good more efficiently, using fewer resources than another nation, making it a superior producer. For example, India's IT services often demonstrate absolute advantage due to its skilled workforce and lower labor costs. Next, we delve into comparative advantage, a more nuanced and powerful concept for explaining trade patterns. This occurs when a country produces a good at a lower opportunity cost, meaning it gives up less to produce it. For instance, India might specialize in software, even if it could produce textiles more efficiently, if software's opportunity cost is lower. Now, let's move beyond the basics to explore some advanced trade theories that explain modern global commerce. These theories offer deeper insights into the complex and evolving patterns of international trade we observe today. Our first advanced theory is the Heckscher-Ohlin theory, focusing on factor endowments in trade. It states countries export goods using abundant, cheap production factors and import those requiring scarce factors. India, for instance, exports labor-intensive goods like textiles and IT services, leveraging its large workforce. Conversely, India imports capital-intensive goods like machinery because capital is a relatively scarcer resource. Next, we examine the new trade theory, which highlights different drivers of comparative advantage. This theory suggests countries gain comparative advantage through economies of scale and powerful network effects. India's IT industry thrives from network effects and scale, creating concentrated expertise and global competitiveness. Similarly, India's pharmaceutical industry utilizes large-scale production, enabling highly competitive pricing in global markets. Now, let's explore how governments actively shape international trade through various policy instruments. Governments use policies like tariffs and non-tariff barriers to influence trade, while agreements like FTAs reduce these barriers for market access. Moving on, we'll now focus on understanding exchange rates, a critical concept in international finance. Exchange rates define currency value, with fixed, floating, and managed float systems reflecting different levels of market and government influence. Let's investigate the key drivers that constantly influence and determine the value of exchange rates. Think of these drivers as radiating from the center, each playing a crucial role in currency fluctuations. First, interest rates are a significant driver, directly impacting currency attractiveness to investors. Higher interest rates attract foreign capital, leading to increased demand for the currency and its appreciation. Next, we consider inflation rates, which also play a vital role in currency valuation. Lower inflation relative to other countries typically increases a currency's value, as purchasing power is maintained. Political stability is another crucial factor, significantly influencing investor confidence and currency strength. Stable political environments attract foreign investors, leading to greater demand for the currency and its strengthening. Finally, current account deficits can also have a substantial impact on exchange rate movements. These deficits often lead to currency depreciation, as more currency is sold to finance rising imports. Let's explore the key components that make up a country's balance of payments, a vital economic record. This balance of payments is essentially a detailed record of all economic transactions between a country and the rest of the world. First up, we have the current account, which is a significant part of the balance of payments. It records trade in goods and services, income from investments, and current transfers such as remittances. Next, we move on to the capital account, another crucial component in understanding global financial flows. This account captures capital transfers, and the acquisition or disposal of non-financial assets, like patents or copyrights. Finally, we have the financial account, which tracks how a country finances its international transactions. It includes transactions involving financial assets and liabilities, such as foreign direct investment, portfolio investment, and reserve assets. Now, let's delve into India's specific exchange rate system, the managed float regime. Since the 1990s, India adopted a managed float, where the rupee is market-driven, but the RBI intervenes to manage volatility. Let's explore the vital role of global economic institutions in shaping our interconnected world economy. These institutions manage, regulate, and promote international economic stability, growth, and cooperation, facilitating trade and providing financial aid. Here, we will focus on some of the key global economic institutions that significantly influence the world economy. These powerful organizations play a crucial role in shaping the economic landscape of our entire world. First, we have the International Monetary Fund, commonly known as the IMF, a key player. The IMF ensures global monetary stability and provides financial assistance to countries in need. Next, let's look at the World Bank Group, an institution dedicated to development. It provides crucial financial and technical aid to support development in developing countries worldwide. Lastly, we have the World Trade Organization, or WTO, which governs global trade rules. The WTO facilitates fair international trade and helps resolve disputes between trading nations. Let's now summarize the key concepts and important topics we've covered in this lecture. Here are the essential takeaways that you should remember from our discussion today. International trade theories explain why countries engage in trade and the mutual benefits they gain. India effectively applies these theories, leveraging its strengths in sectors like IT and textiles for economic growth. Trade policies and international agreements are crucial for shaping economic development and global integration. Exchange rates and the balance of payments are vital tools for analyzing a country's economic health. Global institutions are essential for fostering cooperation, stability, and sustainable development across the world. India actively engages with these global institutions, which significantly influences its economic policies and strategies.